Hi everyone, I'm Nick from Corner Paper, and today we're going to talk about different investment types. And in an earlier video we talked about your investor profile, and with that we talked about one is having financial goals, and then once you have your financial goals, then you look at your time horizon of when you want to reach those goals, and depending on the time horizon you looked at your risk tolerance. So the longer your time horizon, that is, the longer the period you have between now and your goal, is when you can take more risk. And then the shorter the time horizon is when you normally would want to take less risk. So once you have that information, you know whether or not you can handle risk or not. The next step is determining what investments are appropriate in order for you to reach those financial goals. So in today's video, I want to focus on what those appropriate investments might look like depending on your time horizon or your risk tolerance. So I have this sheet of paper here, and in this sheet of paper we have 3 columns. So the first column is looking at your investments. Then in the other 2 columns we have safer or riskier. So from those investments, what might be safer and riskier, and then from there you can determine what's appropriate to invest in depending on your time horizon and financial goals. So, and let's look at it from the top. So the first thing we have is cash. So cash is usually pretty safe to have, and so that's the first thing you might have after you finish working. So what you could do is you could put that in a safe deposit, which is pretty safe, or you could put it in under your mattress. So if you get robbed, that's less safe than having it in a safe deposit box or in a safe in your actual house. The next thing is banks. So with cash you're not making that much money, so you may want to put it in a bank to earn interest. So what's safe is you can put it in a savings account, and in a savings account you're making little interest, but you can take your money out at any time you want. What's riskier is putting it in a CD. So if you want to make more money than a savings account, you can put it in a CD, which is a certificate of deposit, and the reason it's riskier is because there's terms around that. Usually it's a minimum amount that you have to put in there, and second, you have to put it in there for a specific amount of time. So there's usually a contractual obligation of how long you have to keep your money in there. And in finance we call that, we use a word that's called liquidity, and right now there's more liquidity having it in a savings account versus your CD, because liquidity is essentially convenience of when you want to take your money out. So you can take it out anytime in a savings, but you can't really take it out in a CD, unless if you do you get penalized. So there's more risk, there's time risk in the CD. So as far as now getting more into investments, now one of the safest investments compared to the other ones is bonds. So bonds, essentially you're letting someone else borrow your money and they pay it back, that's the principal, and then they pay interest on top of that, which usually is what gives you an incentive to let them borrow to begin with. So the question is, who's borrowing your money? The safest is the government, the US government. They're usually considered the standard or the benchmark because they always pay their money back. They always pay what they owe back and on time. So everything else usually has to pay a higher interest. And so one other customer or one other person you could let borrow your money is a corporation. So corporations pay higher interest, and so from these two, the government is safer. Now I put stocks in 3 different levels, so we'll go through each one of them. But essentially a stock is when you become an investor, so you're letting a company, you're not only letting them borrow your money, but you're in a way becoming a part owner of that company. So you're a shareholder, so you own a piece of that company. And so you can earn money when the stock value goes up, so if they start making a lot of sales and whatever it is that they produce. So as far as stocks, when you buy a stock, you can buy a group of stocks. So a lot of you may, when you have exposure to your retirement account, you may buy stocks in what are called mutual funds. And a mutual fund is essentially a group of stocks. And that's safer than buying an individual stock. So buying an individual stock is buying a share or as many shares in just one company. So if that one company goes bankrupt, you lose all your money. Whereas if that one company was in a group of stocks, then you're still protected because the other stocks would normally do okay if one company went bankrupt. Okay, so that's now buying a group or versus one stock. Now another layer of stocks, if we just look at an individual company, for example, there's all kinds of companies out there. So depending on the company you invest in also determines the risk. So for example, when you buy stocks, a lot of people say utilities are safer than say technology stocks. Because utilities have been around a lot longer, they're bigger companies, and they usually are more stable as far as their stock prices. Where technology companies, there's a lot of competitors, there's a lot of technology coming in and disrupting old technology, so there's a lot more risk, they say. And so these stocks in technology sector usually goes high and low in extremes, so it's a lot more volatile. Now, another way of looking at stocks, so I put a third category here, is basically breaking it down into what's safer usually is bigger, older companies, because they've been around a lot longer, they're a lot more stable generally, versus newer, smaller companies, which are generally not proven yet. Their stock prices go all over the place, and a lot of newer companies go bankrupt. So in general, it's safer to invest in older, bigger companies than it is newer, smaller companies. So as you can see here, we have one more example, but as you can see here so far, depending on your time horizon and your risk tolerance, there's these different categories of investments, and you'll see if you have a longer time horizon, you may want to invest in the riskier ones versus the safer, because the riskier ones, hopefully you earn a higher return in the long run. And I put one more example down here because a lot of these are financial investments, but some common other type of investments are like tangible investments. So your home could be considered an investment, and gold, some people invest in gold coins, that's another type of investment. So between the two, gold could be generally seen as a little bit riskier because the price changes a lot more often than say the value of your home. So this is a good picture of just explaining when it's appropriate to invest in one investment over the other, and you can see that there's options depending on your risk tolerance and investor profile. Thank you.